CoreWeave delivered a massive beat on both the top and bottom lines for the second quarter of 2026.
Huge beat.
Yeah, revenue came in at $2.575 billion. That is up 112% year over year.
Which is just wild.
Right. And it comfortably beat the street consensus of roughly $2.55 to $2.56 billion.
Absolutely.
On the bottom line, EPS was a loss of $103 to $1.14 per share, depending on GAAP and non-GAAP adjustments. But that was significantly better than the expected loss of $1.41 to $1.49.
A lot better.
And furthermore, management actually raised their full-year 2026 revenue guidance to a massive $12.4 billion to $13.2 billion.
Y'all, the market loved that.
Oh, yeah. In response to all of this, the stock surged roughly 13.5 to 15.7% in after-hours trading.
Wow.
It pushed past $102 a share, and crucially, it snapped a brutal 5-quarter streak of post-earnings declines.
Which they really needed.
They did. But, beneath those massive top-line numbers hides a ticking debt bomb and a negative operating margin.
Exactly. And the mission of this deep dive, for you, the listener, is to really tear apart the balance sheet of the market's hottest AI infrastructure stock right now.
Let's do it.
We need to analyze exactly how CoreWeave achieved this revenue beat, break down the significant margin compression that's kind of hiding just beneath that hypergrowth, and evaluate whether the extraordinary debt risks this company's taking on mean they are building a long-term empire or, just a highly leveraged house of cards.
So let's start with the demand side of the equation. Now that we have those headline numbers on the table, we really need to understand the mechanics of where this revenue is actually coming from, right?
Right. And what management sees coming down the pipeline over the next few quarters.
Exactly. Because the top-line explosion is undeniable. That Q2 revenue of $2.575 billion, that represents a 24% sequential growth just from Q1 of 2026.
Just quarter over quarter.
Yeah. And if you think about what a 24% jump in a single quarter actually physically entails for a hardware-heavy company, it's intense.
It means they are activating data center capacity, securing power, and deploying GPUs at an absolute blistering pace.
It isn't just flipping a software switch.
No, not at all.
But the metric that really jumps off the page for me is the revenue backlog.
Oh, the backlog is crazy.
CoreWeave's backlog has reached a staggering $104 billion.
Insane.
That is up 246% year over year. And what is truly crazy is that the $104 billion figure doesn't even include the more than $25 billion in net new customer commitments that they added just in early Q3.
Right, so that's even more on top of it.
We are talking about nearly $130 billion in future demand just lined up at their door.
It is a phenomenal figure. And, from a financial modeling perspective, it provides an incredible amount of visibility into their future revenue streams.
Yeah, totally.
But you have to look at the composition of that demand. When you look at their annualized recurring revenue, or ARR, specifically from hosted inference.
Which is key here.
Right. That number skyrocketed from $1 million to over $100 million in just a few months.
Wow.
And to translate what that means for the business, they aren't just renting out GPUs for short-term bursts so clients can, train an AI model and then leave.
Like a one-off project.
Exactly. Hosted inference means companies are renting CoreWeave's hardware on a continuous, ongoing basis to run their live, customer-facing AI models. That tells you the commercial lifecycle of these GPUs and the everyday, real-world demand for AI workloads is incredibly robust right now. It's shifting from just R&D training to actual live production.
And they are clearly capitalizing on that robust demand, not just with sheer volume, but with serious pricing power.
Definitely.
CoreWeave raised prices across all of their SKUs by roughly 25% in July.
A 25% hike is massive.
It is. And management, specifically CEO Michael Intrater, stated on the call that the company has reached an inflection point where their sheer scale is finally translating into operating leverage.
Right. They believe this quarter reinforced their conviction that AI is foundational and requires a purpose-built platform.
But here's where it gets really interesting. If you think about that $104 billion backlog, it is essentially like a massive, fully leased skyscraper.
Yeah, I like that analogy.
On paper, it looks incredible. You have all these premium tenants signed up, holding the pen, willing to pay top dollar.
Sure.
But the developer still has to actually build the skyscraper.
That's the hard part.
The question for CoreWeave isn't whether the tenants want the space. It's whether they can physically build out the data centers, secure the local power grids, and rack the actual GPUs fast enough for those tenants to move in and start paying rent before the technology cycle moves on.
What's fascinating here is how the broader market dynamics are providing them with the runway to attempt this massive, capital-intensive build-out.
How so?
Well, if you look at the recent analyst note from Bank of America, they explicitly state that the compute market isn't structurally competitive right now.
Meaning what exactly?
We simply aren't in a phase where cloud providers are fighting tooth and nail over price to win clients.
Ah, got it.
The demand for AI compute capacity so far exceeds the available supply that simply having access to the hardware is the primary gating factor for clients.
Just getting in the door.
Exactly. It isn't about agonizing over provider selection or demanding discounts. It is just about getting your hands on raw compute power so your own product doesn't stall out.
That makes sense.
That is why Piper Sandler just initiated coverage on CoreWeave as overweight with a $151 price target. They explicitly named them their top AI infrastructure pick.
Wow, top pick.
Yeah, the market is betting heavily that the demand curve is steep enough to absorb whatever capacity CoreWeave can physically manage to bring online.
But hold on, if they just raise prices by 25% and they have tenants literally begging for space in an uncompetitive market, why did their GAAP operating margin just plummet below zero?
Well, that's the multi-billion-dollar question.
Right. Where's all that money going before the servers even turn on? A $104 billion backlog is an incredible asset, but fulfilling it is clearly incredibly expensive.
Extremely expensive.
And that brings us directly to the margin profile. And the reason why the bottom line, despite this massive revenue beat, is still deep in the red.
Let's get into the numbers.
Let's look at the profitability metrics because they cut a very different picture. Adjusted EBITDA doubled year over year to $1.5 billion.
Which sounds great.
Sounds amazing. However, the adjusted EBITDA margin compressed to 59%. That is down from 62% in Q2 of 2025.
Right.
Then you look at adjusted operating income, which was $128 million. That represents a mere 5% margin, down sharply from 16% a year ago.
That's a steep drop.
But the real kicker for anyone reading this earnings report is the GAAP operating margin. It actually turned negative.
Yeah.
They posted a negative 2% GAAP operating margin, moving from a $19 million profit last year to a $49 million loss this quarter.
Which shocks a lot of people.
Okay, let's unpack this. Wait, you're telling me their infrastructure expenses are moving so fast that they wiped out the gains of doubling their revenue?
Pretty much.
How exactly does a company double its top line to over $2.5 billion, but manage to see its operating margin swing into the negative?
It comes down to the sheer velocity of their expenses, vastly outpacing their revenue recognition.
Okay.
The core issue is that total operating expenses jumped 120% year over year to $2.624 billion.
Good Lord.
Yeah, and when you break that down, the cost of revenue rose 181%, and specifically their technology and infrastructure expenses surged 125% to $1.507 billion in a single quarter.
In one quarter.
In one quarter. To understand the mechanics of this, you have to remember that bringing these massive data centers online requires immense upfront capital and operational spend long before the GPUs are actively generating that top-line revenue.
Oh, I see.
They are aggressively hiring engineers, they are leasing massive industrial facilities, they are securing multi-year power agreements, and crucially, they are beginning to depreciate incredibly expensive hardware the moment it comes online.
Right, right.
All of that hits the operating line immediately and heavily.
Right, so if we extend our skyscraper metaphor, it's like they successfully sold all the premium leases to the building, but now they are being forced to buy this steel at 125% markup.
Exactly.
They are hiring the construction workers on triple overtime, and they are paying a massive high-interest mortgage on the dirt before the tenants have even paid their first month's rent.
That is a perfect way to look at it.
The costs are entirely front-loaded, while the revenue is just going to trickle in over the multi-year life of the contract.
Right.
That perfectly explains why the revenue is exploding, but the operating margins are actively sinking.
Exactly. It's an issue of timing and scale.
Yeah.
However, if you are analyzing the stock, it is vital to note that both management and institutional analysts expect this dynamic to shift.
They do.
Yeah. Bank of America projects that operating margins will improve sequentially throughout the remainder of the year. They're modeling them to reach 14.6% by the fourth quarter of 2026.
Okay, that's a big turnaround.
And management echoed this exact sentiment on the earnings call, guiding for Q4 adjusted operating margins to reach the low teens.
So what's driving that?
The mechanism for this expected improvement is twofold. First, The revenue from that newly activated capacity will finally start to outpace the heavy initial setup costs we just discussed.
That makes sense.
And second, management noted that the newly signed contracts they are currently bringing online carry margins that are 5 to 10 percentage points higher than the cohorts from previous quarters.
Ah, so that price hike.
Exactly.
Yeah.
That 25% July price hike you mentioned earlier, that hasn't fully materialized in the Q2 numbers yet.
Right, because it was in July.
Exactly. It is going to start showing up and heavily padding the bottom line in the back half of the year.
That makes perfect sense conceptually. I mean, if the revenue catches up to the upfront spend, the margins expand.
Right.
But to support those,
Heavily is an understatement.
we absolutely have to look at the balance sheet risk to understand if this breakneck pace of hypergrowth is actually financially sustainable over the long term.
It's the biggest question mark.
Because the numbers here are genuinely staggering.
Yeah.
The balance sheet currently carries $35.1 billion in total debt.
It's just wild.
Let that sink in for a minute. $35 billion. That creates a highly leveraged debt-to-equity ratio of 738.5%.
Which is astronomical.
On top of that, the company is facing clear and present liquidity stress, operating with a current ratio of just 0.3x.
And we really need to translate what that 0.3x current ratio actually means in everyday business terms.
Please do.
For every single dollar of short-term liabilities and bills that CoreWeave has due over the next 12 months, they currently only have 30 cents in liquid cash or equivalent assets on hand to pay them.
Wow, only 30 cents.
Yes. That is severe liquidity stress. It
Yeah.
means there is zero margin for error. And servicing that mountain of debt is taking a massive bite out of their available cash flow. Net interest expenses were $640 million in Q2 alone.
What?
Yeah. That means nearly a quarter of their total Q2 revenue went straight out the door just to pay the interest on their debt.
Wait, $640 million in a single quarter?
In one quarter.
That means they are literally paying over $7 million a day just for the privilege of holding this debt, regardless of whether a single GPU actually gets turned on or a single client pays an invoice.
Exactly.
That is a terrifying burn rate.
It is, and honestly, it is going to get heavier before it gets lighter.
How so?
They are guiding for Q3 interest expenses to jump to a range of $860 million to $940 million as they draw down on newly established loan facilities to fund the next wave of expansion.
You're kidding.
No, you are looking at nearly $1 billion a quarter just to service the debt load.
Almost $1 billion a quarter just in interest.
Interest.
And they still have to actually buy the GPUs and build the data centers.
Yeah, that's extra.
CapEx for Q3 is guided between $11.5 billion and $13.5 billion. For the full year 2026, they raised their CapEx guidance to an eye-watering $35 billion to $39 billion.
It's hard to even wrap your head around those numbers.
When we talk about $39 billion in capital expenditures, we aren't just buying computer chips. We are talking about securing regional power grids, building advanced liquid cooling infrastructure, and erecting massive server farms.
It's heavy industry at this point.
It really is. And while all this capital is being aggressively deployed, there is a very notable risk indicator that any retail investor looking at this stock should be keenly aware of.
Oh, the insider trading.
Yes. Looking at insider trading data from Quiver Quantitative, insiders at CoreWeave have made 1,998 individual sales and absolutely zero purchases in the last 6 months.
Yeah.
Not a single insider buy. That includes CEO Michael Intrater personally selling $620 million worth of his own stock.
That is a critical data point for investor psychology.
Right. Wait, zero purchases.
Zero.
The CEO just sold $620 million in stock.
Yeah.
If I'm a retail investor, watching the captain personally put $620 million into the lifeboats while simultaneously loading the corporate ship with $35 billion in high-interest debt,
Yeah.
well, that makes me incredibly nervous.
Oh, absolutely.
So what does this all mean for the company's trajectory? If we go back to our analogy, CoreWeave is operating exactly like a highly leveraged real estate developer in a boomtown.
Right.
As long as property values, in this specific case, the unquenchable demand for AI compute keep going up, and they can successfully keep hiking prices by 25% to cover their costs, everyone wins.
Everyone's happy.
The debt remains manageable relative to the growth, the operating margins eventually expand as the leases kick in, and that $104 billion backlog turns into a tsunami of cash.
That's the bull case, yeah.
But if demand hiccups even slightly, or if there is any logistical delay in bringing that physical capacity online, say a supply chain issue with cooling equipment, or a delay in local power permitting, the interest payments alone, which are creeping toward $1 billion a quarter, could completely crush them under their own weight.
If we connect this to the bigger picture, you really see the inherent tension in their financial model.
Right.
It's what we call a structural funding gap. Yes, their operating cash flow was positive at $3.66 billion for the first half of 2026, which is undeniably a massive improvement from the severe cash burn they saw a year ago.
True.
But their physical purchases of property and equipment were over $6.4 billion in that exact same period.
Ouch.
Right. That multi-billion-dollar deficit forces CoreWeave to rely on constant, massive infusions of external financing just to keep the lights on and the physical expansion going.
Wow.
We saw this reality play out recently with their massive $2.6 billion debt facility and the $1.75 billion they raised in senior notes.
They just keep borrowing.
They are effectively trapped in a capital cycle where they must continually borrow billions of dollars to build the infrastructure required to service the billions of dollars in debt they already have.
That sounds exhausting.
The operational execution has to be absolutely flawless because the balance sheet offers no cushion.
Flawless execution while managing 738% leverage and paying $7 million a day in interest.
Right.
It really frames the immense stakes for this company moving forward.
Yeah.
They are running on a treadmill that is steadily increasing in speed, and they simply cannot afford to trip.
It absolutely does. And this raises an important question for you to consider as you watch this AI infrastructure space evolve over the next few quarters.
What's that?
CoreWeave's entire financial model and their fundamental ability to service that massive mountain of debt relies heavily on their long-term pricing power.
Which they have right now.
Which they have right now. We saw clear evidence of that power with their recent 25% price hike.
Yeah.
But there are increasing reports surfacing that major tech competitors, specifically giants with massive internal infrastructure like SpaceX and Meta, might soon enter the commercial cloud infrastructure business to sell off their own excess AI computing capacity.
Oh, wow. That would change everything.
Exactly. If these tech behemoths decide to leverage their scale and turn AI compute into a commoditized cut-rate utility, driving prices down across the board just to capture market share, what happens to the lofty margins baked into CoreWeave's $104 billion backlog?
That's a scary thought for investors.
Can a company strapped with a 738% debt-to-equity ratio and a 0.3x current ratio survive a protracted price war against competitors who have infinitely deeper pockets and virtually no debt?
It's the ultimate stress test for that fully leased skyscraper. If the massively capitalized developer next door suddenly starts offering cheaper rent just to fill their own surplus space, those premium tenants might start looking for the exits, or at least demanding aggressive lease renegotiations.
And they wouldn't have much leverage to stop them.
No, they wouldn't. And if that revenue slows down even a fraction, suddenly those billion-dollar quarterly interest payments transition from being a cost of doing business into a fatal problem.
Exactly.
Thank you for tuning in to this deep dive on CoreWeave's complex Q2 earnings. If you want to keep tracking this story, understand the mechanics behind the headlines, and get daily earnings coverage just like this, make sure you follow the show.